Rohr here with an early, concise highlight on Thursday, July 3rd, 2014. And it is going to be concise because much of the foreign exchange is still the same as we discussed on Tuesday. It's on the move again. There's only one item that we're going to visit that's really moved radically. So this will be focused rightfully on the equities and the fixed income. And it is an early update today. It's 5:30 Central Time U.S. because we wanted to get the post and this analysis into the blog well ahead of the U.S. employment report release and ECB press conference. So just a bit of review on the macro side. Wednesday there was little international data. The U.S. saw the bigger than expected plus 280,000 on the ADP jobs figure, normally 2 days ahead of the employment report, but with the accelerated pre-holiday schedule, of course, that came out 1 day ahead yesterday. ISM New York was positive, but factory orders were a bit weak. Now, of course, today is very important because it's the third day of the month. We see all the international services PMIs, and Asia was weak. China, Australia, Japan, all below estimated. The China HSBC services, though, was a bit stronger than expected. And in Europe, interesting, again, the periphery did okay on the services PMI, but Germany and France, and then after that the UK were all weak, along with Eurozone retail sales. So weak news today. It's another example of the equities treating bad news as good news once again. They're all up. And we've got the ECB at 7:30 Central Time, but that's moot because they made their major move last time, and everyone's still sorting out just what the ECB accommodation program means. More important, of course, at the same time that starts 7:30 U.S. Central Time, U.S. employment report, which has been upgraded on its estimate from 205 to 215,000 after the ADP number yesterday, and we'll also see the services PMI. But speaking of the equities being up on a bit of a bad news is good news today, the S&P future, as we sit right now, is up 2.5 at 1970. And that's very important because the 1971 that we ran up and tested on Tuesday, also on weak news. On the first day of the month, though, we were imagining it was investment flows coming in. 1971 is the top of the significant weekly channel. And looking at the oscillator resistance, it was right around 1965. And lo and behold, where did the market hold all of the pullbacks going back to later on Tuesday into early and late on Wednesday, 1965. So the issue today is, in order to show any real, even initial downside weakness, the bears need to knock the September S&P future below 1965 again to say it has not only respected the top of the channel up at 71, but it is also fading back from the weekly oscillator resistance. And to boot, the market held right into around the channel support, the aggressive channel support up from the last correction low back in the key and remaining key, if the market should get down that far, 1938 overrun objective. And from that last low down at 1936, going back into last week on Thursday morning, the aggressive upward channel. And this is always very interesting. Market stalls, consolidates quietly, worked its way out to the aggressive upward channel, and managed to hold. So again, all the burden of proof is on the bears today into and after the U.S. employment report, because they have not been able, either on dips last week after the Tuesday reversal or on the consolidation out of Tuesday into Wednesday this week, they've been unable to get the market to break any of the key support. And next resistances, if we're above 71, as you'll see, there's somewhat of a topping activity into about 85, but the bigger oscillator resistances out of this week and especially in the next week are a minimum of 1990, with next week being 1995 to 2000, which makes sense. You're getting close enough that if the bears can't get this market to break, 2000 may act like a bit of a magnet. It's also going to be very interesting today to see if the short-term indications, like the hourly MACD, especially on any strength, can get back out above its upper runaway band. It slipped back below during the consolidation yesterday. That's pretty much it for the short-term view of the S&P 500. Moving over to the intermediate-term view, you can see that downside reversal from last week Tuesday that made the 1953 to 55 area so critical, and after dipping to 38 for a couple of sessions, the market was unable to remain below it as the new quarter started on Tuesday. Gapping above it Tuesday morning really fed the fire to get right up to 71, and here is that long-term major channel, weekly channel topping line. This is off the significant 1068 low from all the way back in 2011, and you can see how the market not only tested or neared it at times previous, late last year into this year, but it's been up against it for over a month now. This is the sort of thing where it's either got to escape or maybe there's a bigger correction than most people think is possible. And with that, the intermediate term on the S&P will remain any initial pullback to the mid-1950s. The gap, the overrun resistance, is going to be your key support.